Welcome to Options Brew TV Market Shot with Mark Phillips of Harvested Financial. Mark, how are you? Welcome.
Good, Lex. How are you doing today?
Good. You told me you have a little bit of a hoarse voice, a little from talking so much. We have so much going on, right? We're always busy and yapping away, right?
Busy in these markets. Hey, with 45 million contracts trading a day, there's a lot to do out there.
There's a lot to do. That's right. We talked earlier, a little going back to the GameStop, huh? We had another event last night after hours. GameStop popped, I think. I think at one point it might have started pushing $200 last night after hours. Is that correct?
I believe it did. Yeah. And right now we're trading up $42 to sitting around 135 right now.
Okay.
So still up quite a bit this morning.
Yeah. Okay. Crazy. So my guess is that implied volatility is, right through the roof again, right? In the options.
Completely through the
Oh,
roof.
okay. And just complete craziness again. Any thoughts on what happened? I have to be honest, I did not pay attention to the news story yet. I've just been a little busy, but what's going on? Do we know?
We're squeezing again. It's crazy. You go to the message boards, you go to Reddit, you go to StockTwits, you go to any of these places out there, and they're just streams of data. Like every single post is updated within the last 2 seconds. Everyone is just jumping in these things, and they're trying to run a squeeze again on this, I guess. I don't know that there's actually all that much of a true news event around this.
Okay. Your screen?
I do, yeah, because there's some, like you said, there's some really interesting volatility things happening here. And like when we saw it run up the last time, a lot of people jumped in and started to think about how they could play with the options, and some funky things happen when you're trading 500, 1,000 implied volatility.
Right.
I want to talk about some of the volatility numbers that we're seeing here. So front month, this is only a day away. That's pricing 1,000 vol. It's hard to find many vol applications that'll hold 4 digits in them. And we're just not used to seeing these kinds of numbers.
I have to get the calculator out again. I'll start messing around while you're doing this. 1,000 volatility. Look at the straddle. It's $62 or something like that. $63.
63, and it's decaying fast. I was looking at this morning. It was a $75 straddle. So for options expiring in 1 day, there's like a trading day and a half left.
Oh my God.
And it's pricing, almost a 45-50% move in the stock.
I'm messing around the calculator, but go ahead. I'm listening.
So yeah, I mean, at some level, the 1,000 vol with only 1 day to expiration, that's more about the straddle price, like exactly like you pointed out.
Right.
But even if we go to the March serial expiration, we're seeing a 500 vol and 400 vol in April, 385, I guess. But even all the way out to some of these back months, they're still, the furthest out, the Jan 22 leaps, I guess there are 23s too, but these are trading at 190, 155 vol. Like people are expecting this to move.
Yeah. Well, think about this though, from the downside perspective, if we could sell that option for $180, it covers the whole downside.
There you go.
You can't lose to the downside on that. Now, clearly you have problems to the upside. We'd have to figure out a third leg to protect ourselves, but man, that's insanity.
Well, and that's actually a great point about the downside versus the upside, because it seems like all the risk is to the upside here. If you look at where these options are listed, so I'm back in April here.
Yep.
But they're listed all the way up to $800.
Wait, the 800 and what? Yeah, April 49 days ago. The 800 is how much was that?
That 800 call is trading $27.
$27. Oh my God.
I mean, that's where you have to get that implied vol number, because, if you're selling that option, you're concerned about your upsides. You're concerned about this unlimited squeeze potential. This isn't a downside risk question. This is how far does this go?
Yeah, right. Now I would imagine though that, the first time this happened, we had the squeeze vigilantes out there, let's say, and they really banded together somehow and ran this baby up, right? But one of the reasons that could happen is because there was a big short interest in the stock. So people got squeezed, or institutions, hedge funds got squeezed. My guess is there aren't as many of those people after that experience. They're like, wait a minute, I don't want to do that again, at least to the size I did it, right? So do we really have this massive upside risk the second time around without as many shorts out there potentially, or am I just way off and there are that many shorts again? I don't know.
No, it's a good question. I don't have exact numbers on the shorts, but everything I've seen has suggested exactly what you're saying, that
Hmm.
the short interest is coming down.
Okay.
It was over 100% when we first started. I think the last number I saw, they were down in the 30s.
Oh, okay. So
So,
that's a big difference.
huge difference there.
Yeah. Got
And,
it.
my interpretation, is just my interpretation, but, people are just concerned about the potential for it to go. That, like, it might not even necessarily be the buyers are coming in. It's that any seller, long or short, is still going to be a little trigger shy here.
Sure. Sure. Got it. Okay. Yeah. And this thing kind of, GameStop sort of settled down for a couple weeks here, right? We got down to, the $40 range. It looks like it kind of hummed around there a little bit, nothing crazy. And then all of a sudden, bam, we get the next shoe to drop here.
Exactly. So, of course, this enormous spike that we're seeing here, that was the last round.
Right.
But vol also went up through the roof too. So we got the yellow line that's your stock price, and then the white line that are the implied vol levels.
Mhm.
So stock got all the way up to 340, vol through the roof,
Yep.
but then it settled right back down. And
Mhm.
so it settled back down to only 140 vol stock.
Right. And that's right about here, thereabouts, right?
Exactly.
Yeah.
And so, vols settled in. And one of the things that we saw with the last round of, GameStop was that people say, okay, the stock price is too high, it's too elevated.
Mhm.
Let's, buy puts. That seems like the obvious play. You think it's going down, buy a put. But I want to show just how expensive these puts are in volatility terms,
Yep.
and what a reversion in that volatility might do to your put position. So if we're sitting here in April, and we're at, call it the 130 level, stock's trading right around 130 right now.
Yep.
The 100 the 100 put in April is trading around $45 right now.
Yep.
So I'm going to pull up the Vega right
Okay.
now.
So
So
Vega is the measure of a 1 point move in volatility, how much that will affect the option price, right?
bingo, it is the
Okay.
option sensitivity to changes in implied volatility.
Okay. So I see a pretty big number, but go ahead. Let's hear it.
So the number doesn't look big until you start thinking about what it means. So I think you're referring to this 13 cents right
Yes.
here. And so 13 cents doesn't sound like a lot, but that means that for every point in implied volatility changes, that options price is going to change by 13 cents.
Mm-hmm.
So we're at 400 vol right now. If we go back down to where we were trading in the lowly 150 vol levels,
Mm-hmm.
we've lost 250 points of volatility. So 250 points of volatility times 13 cents, that option is going to lose $32 in value. That's 2/3 of the price.
Right.
So we go from a $45 option to a $13 option if vol comes back down to where it was just a week ago.
Right. Right. And that's a position that can lose if the stock goes down. Now, clearly, if the stock goes down far enough, it becomes a deep in the money put, and we save the day that way. But if it runs down to $90 and kind of just sits there, that option, it's got $10 of intrinsic value, right? And probably not much more at the new implied volatility if it just kind of sits. So that's a bad day.
That's a bad day. I mean, a
Yeah.
little bit of vol coming in, and all of a sudden you're just going to get crushed on the value of that put. So you could be right. You could be 30, 40, stock could go down $60 and you could lose money on this.
Yeah. So yeah, you can't, I guess the bottom line here is probably not the world's greatest idea to just be long naked options. We have to combine them with spreads of some kind where we're actually buying something and selling something, and being strategic about that thing. I mean, I guess, God, what can we do here? Can we sell a call spread or buy a put? I mean, I hate saying the word buy in 1,000 volatility, right?
It's tough because, like, I think, if you were going to take this, same spread and say spread it off, so you're long the 100 put, maybe you sell the 80 put. Maybe you want to,
Sure.
you're definitely bearish on this. You have a 20-point vertical. you're paying almost $15 for that 20 point. For a 20 point vertical that is $30 away from your long leg.
Right. That's a lot.
So, it's like these options are so alike in such a high vol environment that the likeness of that April 80, April 100 put, they're just so similar that they're, that in a high vol environment where stocks, a 400 vol means, I forget, did you do the calculation yet? How much that's moving a day?
I didn't. I was doing different numbers though. It was $135 stock, right? Would you say,
Yeah.
what's the vol? 500?
I did 400 is
Okay.
divided by 16. I mean, that's a 25% move every day.
Yeah. So let's see what that looks like in terms of the price. So you said 400, right?
Yeah, that's where we're looking right now.
I'm computing. It's like a $34 move
Every day.
every day. I mean, it's insanity.
Right. So those two, a $20 spread, like, if it's moving $30 around, those two are relatively similar in the grand scheme of things, 49 days out in the future. When vol gets this high, it's hard to know what to do. You have to be very directionally correct if you're going to engage in some of these option strategies.
Right. Right. Yeah. Or look at, we could do something crazy if we had a downside bias and we wanted to take advantage of the high volatility. We could do, one of those jaded butterfly. What do they call those broken wing butterflies? So like a 2x3x1 and lean it, and try to get some juice that way. So you could do some crazy stuff, right?
No, like a broken wing butterfly, it would be a great setup here. Because it does allow you to be that sort of short volatility, and while collecting a credit for, selling that vol, but leaning with a directional bend.
Right.
I even just set up a little bit of an even butterfly right here, an even wing butterfly. The $20 fly, it only costs $1.90 right now. So like your max value on that could be $20, but because things are banging around all over the place, the chances of that pinning at 80, 49 days in the future, needle in a haystack.
Sure. Wow. That's unreal.
But you can do some fun stuff like, if you adjust these legs down that way, you're going to take in a little bit of a credit here.
I mean, the most you can use is 1,000 forever, and you get that whole, right?
Right. And you do have that sweet spot to the downside, call it between 100 and, all the way down to, at zero,
yeah, down to 64 or whatever that was. Yeah.
Right.
Wow.
So, there's certainly ways to play this and start getting interesting with the ratios and whatnot, but some of the traditional spreads that we're used to here just start looking real funky at these high vol levels.
Options with really, really high volatility like this, implied volatility, they tend to look alike. You said that earlier, and that's an important quality. Everything tends toward a 50 delta when you have monster volatility, because guess what? Any at the money could happen in high volatility. It could be 200, it can be 100, it can be 400, it can be, 60. So if that's the case, I got a coin toss of anywhere, it seems like, with a 50 delta, right?
Yep. The the way I like to think about that is it's sort of like the probability distribution curve, that sort of like bell curve that you see in high volatility, that just gets flattened.
Right.
And so the probability of any price level along that spectrum is about equal.
Exactly.
While it's relatively low, it's going to be a nice pointed bell curve, and it's most likely to land right there. And there are big differences across those price levels. But when everything looks the same, all the options are alike and they're all equally possible.
Yeah.
Really interesting example right here of what can happen in the options markets.
Yeah, well, let's keep an eye on this one. We'd like to, when these kind of events come up, Mark and I like to do a little summary of what's going on. So this was a perfect one for us, GME again, even though it's the second time we've done it, but it's in the news. So we'll chat about that. We'll keep an eye out on that one. Well, thanks a bunch, Mark. Always a pleasure. We'll see you next week.
Absolutely, Lex. Yeah, thanks for having me.
Okay. Have a good weekend.
You too.